Hello Forex traders and welcome to our 𝖢𝖥𝖣yi Academy Intermediate Forex Trading Guide Part 1, where we delve deeper into oscillators, chart patterns and pivot points. Today we're exploring three key elements of Forex trading. We'll start with oscillators and momentum indicators, useful tools for timing trades. Next we'll discuss the importance of recognizing chart patterns, and finally we'll explain pivot points. So oscillators and momentum indicators can help you identify potential entry exit points in the market. They're designed to help you understand whether a currency is overbought or oversold, providing insights into potential future price movements. Now, there are multiple oscillators and many oscillators out there, but let's just focus on the most common ones. So we have the RSI, or the relative strength index. We have the MACD, or the moving average convergence divergence, and the stochastic oscillator. Each of these tools help traders identify market extremes and potential turning points. Now, oscillators can provide trading signals through a process known as divergence and convergence. And divergence occurs when the price of an asset is heading in opposite directions. So for instance, here in this example, we can see that price is making lower lows here, but the RSI is making a higher low. This is a type of divergence in the market, and it's basically telling us that the strength of the new low being formed isn't as strong as the oscillator is telling us. And you can see after the fact price rallies to the upside. An example of convergence is when price agrees with the oscillator. So price is making lower lows through here. The oscillator also agrees with price making lower lows. Really good for potential trend continuation. Moving on to the example of a live in action divergence here on the Australian dollar versus the US dollar, we can see that the market comes up into a level of resistance. Now, this is important when you're looking at convergence and divergence. Divergence in particular is a really powerful trading strategy, and you want to be focusing on these at key levels of support or resistance. You don't just want to look at them anywhere in the markets. You got to make sure that it is at a key area of resistance, and you can see this area at the 0.68 handle was a level of resistance. We've come into this area on a couple of occasions and price has kind of faded away from it. On this occasion here, you can see that price begins to make a higher high, and if I in fact grab this pen tool here, you can see when price makes a higher high, however, our RSI is making a lower high. So that's telling us that this new high that's been formed at this resistance level is not as strong, or it basically lacks momentum to the upside. And you can see what happens after that. Price turns and we move lower. Going on to chart patterns then. So these are distinct formations created by the price movements of an asset on a price chart. So chart patterns are crucial for traders because they can suggest future price movement. Now let's delve into most common patterns you'll encounter, and among the most common chart patterns are the head and shoulders pattern. You can see here that's when price creates a higher high and then comes in and creates a lower high. That's known as the right shoulder. We also have the double top slash bottom patterns. This in particular is my favorite type of trading and can be really useful at areas of support and resistance, and actually very useful if you combine it with the RSI looking for that divergence. And the final pattern is a flag pattern. That's when price accelerates in a particular direction, it consolidates and then continues to move in the direction that it came in from. Now, each pattern can signal whether a currency pair is likely to continue on its current trend or reverse it. Let's have a look at some real life examples. So again, I'm on the Australian dollar versus the US dollar chart. We can see that price has come to an area of resistance just through there where this previous high was. You can look left, you can see price coming into that area. The market forms higher highs into that point. However, after we hit the resistance, the market makes a lower high. So you've got the pattern there that the market is making, which is that left shoulder, head, right shoulder. Now this line through here is what we call the neckline of the pattern, and that is when the pattern technically completes. So when we do see price trade through it and break through and close below that neckline area, that is technically when the pattern completes, and quite often we can see price continue to the downside as it does show a potential trend reversal forming. The double bottom / top pattern in this example here, I'm just going to show you what a double bottom looks like, and you can see price comes into a level of support being the 0.6700 area. We come into the level, price then comes back into the level, and we kind of have a similar opening and closing price as the previous low there. Now again, very similar to a head and shoulders pattern, we have what we call a neckline, which is the sort of peak of the high that has been formed. Price has traded through, retests it, and then what we see is a trend reversal from that point. Again, very important that these occur at support or resistance levels, depending on which type of pattern you are looking to get involved with. The flag pattern is a little bit different. The flag pattern usually occurs after quite a large acceleration in price, and what I mean by that is price came into a supporting level here. We had quite an aggressive move to the upside. After that aggressive move, price consolidates within a particular area, a particular tight trading range, which can often look like a flag at the top of a pole. That's why it's called the flag pattern. Typically, price will break out in the direction that it came into the flag from, and you can see price extends to the upside here. So now that we're familiar with these patterns, we can go and have a look at our next topic, which is pivot points. So pivot points are technical analysis indicators that provide a set of potential support and resistance levels. They're calculated using the high, the low, and the closing price of a currency pair from the previous trading period. The standard pivot point is calculated as an average of the high, low, and closing prices from the previous day, and around this pivot point we calculate several resistance and support levels which can provide potential entry and exit points. So let's go and have a look at an example of that. So these are the pivot points on the chart. Now the white line in here is what we call the standard pivot point. Like we just said, that is calculated as an average from the high and low and closing prices of the previous day. What we then have is blue lines below that and red lines above that. Now what they call classed as are R1, S1, S2, R2, and it can go up to R5. So you can see here, for example, the red line here is R1, so that means resistance 1, and the blue line here is support 1. The dotted line through here is support 2. Now, as we can see, as the day developed, we rejected from the main pivot point. We came all the way down to the S1, which is the support 1 pivot point. We rallied all the way up to R1, which is resistance 1. We then came into the pivot point, rejected there, retested R1, fell all the way down to S1, broke through that, broke through S2, and then ended up just developing around that S2 area. So you can see on the occasions on this particular day, we tested 1, 2, 3, 4, 5, 6 times around these pivot points. So you can see how they can be used in conjunction with your trading. We've covered a lot today: oscillators, chart patterns, and pivot points. Remember, each of these tools bring its unique value to your trading strategy, and when used together, they can significantly increase your trading success. Thank you for watching the Blueberry Markets Intermediate Part 1. See you in Part 2.